Core CPI is a measure of inflation. It tracks the average change in prices paid by consumers for a basket of goods and services. Core CPI excludes food and energy prices. These prices are volatile. The MM in Core CPI stands for month over month. It reflects the change in Core CPI from the previous month. Core CPI is a key indicator of inflation. It helps policymakers, businesses, and investors understand price trends. Central banks like the Federal Reserve closely monitor Core CPI. They use it to make decisions about interest rates. A higher than expected Core CPI reading can signal rising inflation. This often leads to a tightening of monetary policy. Understanding Core CPI is crucial for traders. It provides insights into the health of the economy. It can also influence asset prices. By tracking Core CPI traders can anticipate potential market movements. This allows them to make informed trading decisions. In summary, Core CPI is an important economic indicator. It helps us understand inflation and its potential impact. By tracking Core CPI, traders can gain an edge in the market. Core CPI data releases can significantly impact financial markets. Traders use this data to make decisions about stocks, bonds, and currencies. When Core CPI is higher than expected, it suggests that inflation is rising faster than anticipated. Rising inflation erodes the purchasing power of money. This can lead to higher interest rates. As a result, investors may demand higher yields on bonds. This causes bond prices to fall. Higher interest rates can also slow down economic growth. This makes stocks less attractive to investors. Conversely, a lower than expected Core CPI reading may indicate that inflation is under control. This can lead to lower interest rates. Lower interest rates can boost economic growth. This makes stocks more appealing to investors. Traders closely watch Core CPI data releases. They adjust their portfolios based on the information. Understanding the relationship between Core CPI and asset prices is crucial for successful trading. Core CPI and PPI are both inflation indicators. However, they measure different things. Core CPI measures the change in prices paid by consumers. PPI measures the change in prices received by producers. There is a relationship between Core CPI and PPI. Changes in PPI can eventually pass through to consumer prices. For example, if producers face higher input costs, they may raise prices. This would be reflected in the PPI. These higher prices would eventually be passed on to consumers. This would then be reflected in the Core CPI. However, the relationship between Core CPI and PPI is not always direct or immediate. There is often a lag between changes in PPI and changes in Core CPI. This lag can vary depending on factors such as the competitiveness of the market and the ability of businesses to absorb higher costs. Traders monitor both Core CPI and PPI to get a comprehensive view of inflation. PPI can provide early warning signs of inflationary pressures. This can be helpful in anticipating future movements in Core CPI. Traders use various strategies based on Core CPI outcomes. Here are a few examples. Trend following. If Core CPI is trending higher, traders may buy inflation-hedged assets. These include commodities, real estate, and inflation-protected securities. Mean reversion. If Core CPI deviates significantly from its historical average, traders may bet on a reversal. For example, if Core CPI is very high, they may short inflation-sensitive assets. Currency trading Core CPI can impact currency exchange rates. If Core CPI is higher in one country than another, its currency may depreciate. Traders may use this information to make Forex trades. It's important to note that these are just a few examples. Trading strategies should be tailored to individual risk tolerance, investment goals, and market conditions. Remember, trading involves risks. It's important to conduct thorough research, understand the market, and manage risks effectively.